Good afternoon. Thank you for joining us on a very hot day. We are here today to hear from Supreme PLC, who have announced their results this week. This will be an opportunity for Q&A at the end, but to begin with, we shall hear from Sandy Chadha, who will talk you through the presentation. Over to you, Sandy.
Thank you, Hannah. Welcome to the forum, and I'm so grateful that so many of you have turned up to listen to us today. I'm Sandy Chadha, I'm CEO of the Supreme PLC, and on the call we have Suzanne, who is the CFO. This on the slide you see is our team, and we have a divisional MD or director in every division that we do. And I'm going to come on to a bit more detail about what they do and how it all fits together in the next slide, the next few slides. Hannah, if you can move on. Okay, so I think what would be a good idea is to start from the beginning, because it makes it a lot easier to people to understand how we are in so many different areas and how they all work together, because from an outsider it just doesn't make sense. So the business started in 1975. My father, who founded the business. I joined in 1991, and that was the first introduction to batteries. And how it came about was I was at a trade show. We were actually clearing down a lot of the sort of small accessories and products that we're selling. The revenues at the time was between $500,000 to $1 million of our small store. As we were at the exhibition, somebody gave us some samples of some Duracell on clearance. We managed to get lots of orders. There was a big demand for some reason of batteries on the show. And the main reason for the demand was that a lot of independents didn't have access to Duracell. At the time, Eveready was quite a popular brand. So when we displayed it on our exhibition, we got a lot of demand and a lot of orders. And after the show, I contacted Duracell and I said, we've got a great demand here. We think we can, really do well with your product. Unfortunately, I didn't get any success from them. But what we did find is that in Germany, because of the parallel trade market and the price settings of Duracell in Germany are much lower than the UK, I thought it was interesting to go and have a look over there. I literally flew over, had a look at the yellow pages and found a wholesaler that spoke English and brought back some Duracell batteries. And that was the start of our battery division. I hired Andrew Beaumont, that you saw on the slide before, who's been with us since 1991. And he focused on the selling, and I focused on the importing on this grey market of Duracell batteries. What was really interesting about batteries is it was so easy to sell. Like any outlet sold them. It didn't matter whether it was a hardware, DIY, electrically, stationary, toys, gifts. You could sell it pretty much anywhere. And that meant that it was so easy to penetrate the UK market because I was selling at a very good, attractive price, being in the grey market. The business grew really fast through the 90s, double digits. And what we found with batteries is that even though you could sell it everywhere, the gross margin as a distributor was pretty low. It was only about 10, 11%. So we had to keep our overheads really low, which actually meant in the early days, it kept us in check with our overheads. So if our margin is 11% on our overheads and 5%, the differences is what we make. So we looked at it a few years into this distribution agreements after we got with Duracell Energizer, because we grew big enough for them to actually supply us direct. We thought, well, hang on, we're only making a 10, 11% margin being a distributor for Duracell, Panasonic, or Energizer. Let's have a look what else we can do. And we came across licensing, and we licensed the JCB, the Samsung and Philips batteries back in the late 90s, early 2000s. And what we found when we licensed the brand of batteries is that the margins grew for us, and also it replaced private label in a lot of these sort of like the discounters. And we found that it sort of entered into a market where there was nobody else really selling a licensed battery, and our margins were far greater. So the business carried on growing from being a licensee as well as a distributor till about 2007 or 2008. And that's when we came across the lighting industry. And again, we plateaued around about 20, 25 million revenues in batteries, making about 11 to 13% gross margin. And we decided that we need to move into a new category, which we identified as being lighting, similar sort of customer base, similar sort of buyers. It sort of made sense to look at the industry. And instead of going to Philips or being a distributor, we decided, let's just try the license, because it worked really well in the batteries. We got connection with our Eveready and Energizer friends, asked them if they want to license their brand for a light bulb, which they don't make. They did. We did a deal within a few weeks. We hired David Nielsen, who's with us today, who runs the category. And he did a great job of bringing 300-400 products specializing in lighting. And we launched into our existing customers, but also into hardware and DIY customers. And it was just an overnight success. And it took off. And what we found was the margin was a lot better, again, because of it being a licensed product. It was in the 30s rather than in the 10s and 15s. And the other thing we found is that, and this was the most interesting learning curve, was that when I introduced the lighting division, I hired David and he hired 1 or 2 other people. But that was the overheads. There was no other overheads associated with the lighting division. So the sales and the gross profit, the actual cash gross profit, came straight to the bottom line. There was no additional capex or overheads associated with the lighting division. So as that grew, our bottom line grew, and it grew faster because of the reason I explained. There was no overheads associated. We grew that business really well over the last 10, 15 years and still growing today. And we've moved into industrial lighting, into business to business area, online. There's a lot of areas in lighting there is there, and it's worked successfully. And today we have lots of brands, Energizer, JCB, and Eveready to name a few. In 2013, or end of 2013, January 2014, we decided to move into the vaping business. And I guess this was sort of like the real turning point for Supreme, because this is a point where we entered into the market with our own brand. Normally we have got licensed brands or a distributor. So we became our own brand. And I think we were able to do that on the vaping because we came into the market at the right time. There wasn't any established brands. So it made sense to have your own brand. But what else was really a big turning point was the manufacturing. I think we started with the imports from China, but very quickly, within 18 months, 2 years, we decided that the right thing was to manufacture vaping in the UK. And what we found about UK manufacturing is that back in the 70s, 80s, it all moved to China because the labor costs were too expensive in the UK. But what's happened more recently in the last 10, 15 years is that the machinery has become a lot more robotic, a lot more automated. It means then that we can actually cut down the cost of labor. And as long as the labor cost is below the 10% of the value of the goods, then it is worth looking at manufacturing in the UK. And we did that successfully with vaping. And as I said, vaping was a first time we manufactured, but it's also the first time we owned our own brand. And the brand initially was Kick, but then we moved very quickly into 88 Vape, which is our discount brand. We looked at the market and we thought everybody is focusing on the top end and they're all fighting over being the most premium, the best quality. We thought, well, hang on, all vaping liquids are the same quality or very similar quality. It's just a flavor and preference. Let's focus on the bottom end where a lot of our discounters are, and let's introduce a £1 product with 88 Vape, and let's try and sell it into there. So we launched 88 Vape in 2015, and unfortunately, we got no traction. None of the discounters sold vaping. None of the retailers that we went to were really that interested in vaping. They're associated with tobacco too much, and they don't sell cigarettes. So we looked at how can we penetrate that market, and what we actually did is we actually gave the stock away free. So we actually went to Poundland and some of the other discounters and say, hey guys, here's an FSDU, a floor standing unit full of merchandise in 50 stores. Please give it a go. And if it doesn't sell, well, it doesn't matter. But if you do sell well, maybe you can carry on. They all Poundland was the first one to adopt it and said, yeah, okay, we'll try it, but Cadbury's or somebody else will take over in a few weeks and you'll be out. But it's free. We've got nothing to lose. We'll just take it off you. They took it, and I think I got a call in 2-3 days saying this is just flying off the shelf. How quick can you roll out? How quick can you get a floor stand to 800 stores? And then when Poundland rolled out, then the other discounters followed, and we have demonstrated the success on one into all the discounters, and then moved into convenience, and then into grocery with Asda, now recently with Sainsbury's and Iceland. And it is now across pretty much across both convenience, grocery, and discount, as well as online. It really is penetrated the market. It's something like 30% at volume as being the budget brand of the UK market. And I think one thing it demonstrated is not only can we create our own brand, spending marketing and advertising, but also we can actually manufacture. And as we manufacture more and more, we got better at it and more efficient at it. And then we looked at our manufacturing chain and thought, well, this is a product for £1, and we don't think we want to go above that, even though we're so much cheaper than everybody else. And we thought, how else can we get more margin? And the easy answer was just more efficiencies in your supply chain going backwards. And we looked at our bottles and we thought, well, that's a really expensive part of the process. Can we make our own bottle? Well, of course we can make our own bottle. So we invested in machinery and now we make our own bottle, which was at that point the most expensive part of the process. And we go back in our supply chain and see what else can we make. So we, rather than relying on so many suppliers, we actually vertically integrate backwards, giving us more margin. So that was a huge success, and I think 88 Vape now is probably the most profitable part of most of our customers' store retail store space. So the space they give up, the cash it generates, vaping is probably there, followed probably close behind by lighting and batteries. So it's become really fundamental. And the other thing we followed is that we had a few small acquisitions, and what we found when we made acquisitions, the same thing when we moved into the lighting division or the vaping division, is that the overhead base doesn't go up the same level, especially if you can strip out the overheads. So in the vaping division, there is Mike Holliday, who's run that from day one, and he's got a team of 4 people. That's it. That's our vaping division. Ignoring the factory, there's 150 people, but the actual running of that. And if you think when we're competing against another vaping business or another lighting business or another battery business, they've got their fixed costs, which will be premises, a finance team, a distribution hub, a design team, a sales team. You know, they've got all these overheads. Well, we've got those too, but they're already actually paid for by the first division we're in, which is batteries. So as we grew more and more, we found that the overheads didn't go in line with the actual sales and the gross profit, and it fell to the bottom line. And that's same with the acquisitions that we made, is that we cut out the overheads, motivated the sales team and the marketing team, but brought it into our premises for our DC distribution and our finance team to chase the money and our marketing to design the products. And it worked really well. And as more and more we've done, we've got more efficient at it. The first few were a little bit difficult and they're small, but now we're getting more and more efficient. Moving on to 2018, we decided, right, we've done so well with our own brand and manufacturing. What else can we manufacture? What else can we license? What else can we own a brand? Why should a customer, why should a big supermarket or a big discount, why should they buy from us? We need to give a very strong reason, and not only buy from us once, buy from us and as a long-term partnership. So we decided, well, sports nutrition, this whole wellness category, like vaping, is in growth, and all our customers have it in common. So lighting, batteries, vaping, sports nutrition, wellness, vitamins, all our customers, or as a big proportion of our customers, sell all these products. So we thought, let's move into the sports nutrition market. I know a little bit about sports nutrition in terms of I take the product, but that was about it. Manufacturing it or blending it, I had absolutely no idea. So I hired in a guy that's with us now, Dan Clark, and we ended up buying a facility out in Ireland that went into liquidation. It was £100,000 to buy this machinery. We took on the staff that were there, and their largest customer was one of our discounters. So all of a sudden, we were in our second or third biggest discounter with sports nutrition, just by the fact that we bought this business that had gone into administration in Ireland. We learned the know-how, we understood everything. We brought that business back into the UK, and then we've added 1 or 2 other sort of small to medium-sized sports nutrition businesses into it. What we found in the sports nutrition category was, and like other categories, is that very few businesses between 5 and 15 million pounds in revenue make much money. In fact, they probably lose money. And after a while of struggling along, they create a great brand, but they just don't get the economies to make the profit. So we're able to pick these sort of businesses up relatively cheap and integrate them into our business. And that's what we've done pretty well with the sports nutrition. And that's a new category where we've licensed a brand. We have got we've got private label we make for some of the supermarkets and the discounters, but we also can establish our own brand. And that's what we're doing in the vitamins. And vitamins in particularly, the manufacturing where the powders is a little bit bigger machinery and it's a bit more in depth. Vitamin manufacturing is so simple and straightforward in terms of machinery and the know-how that we've actually looked at the market and decided, well, why is everyone so expensive when the product's so low cost to make? And I'm going to come on to a little bit more on that in the future. That sort of gives us a sort of starting point to where we are now in our history, and I'll hopefully explain why we've got all these different divisions. This diagram really shows our vertically integrated platform. these are all shared services. So we've got 5 people in the design, and they design everything, whatever the company needs. And we find that it works really cost effective. If you ask me to split down how much do we just make from batteries, how much do we make net profit from lighting, we couldn't be able to give you that information. I can give you the sales and the gross profit, but we couldn't give you the bottom line. And with Cymex was a new brand we bought, and BattleBite, we put it into the top. We then use our services that you can see in the middle, and then the outlets at the bottom, whether it's online or whether it's through our chain of 3,300 customers selling into 40,000 outlets. And that's our model really in a very simplistic way. And it works really effective, and it's really pretty unique. I mean, there's very few companies that have a sort of a vertically platform that's similar to this. And this has also shown that it's not only is it working now, we can scale this more and more. For example, BattleBite, when we bought that business last October, it had revenues of about 1.8. We've grown it 50% since it's plugged into our platform. So we've actually grown the revenues. So not only have we reduced the overheads and the staff and the warehouse and the premises, we've actually grown the top line, because all we've done is a whole portfolio of customers that are now buying it that weren't buying it before. And this makes the actual delivery and the processing of customer order so much easier when they're buying all our products in one go. Move on to the next slide, please, Heather. Thanks. This is a slide that you saw. I mean, the figures 122 million, and I'm gonna not linger on this slide too much because I want Suzanne more to cover the numbers. But moving on here, and just a little bit about the industries we're in, really. I mean, we're so lucky that vaping, sports nutrition, wellness, vitamins, and the industries that we're all going to are really growing. But not only are they growing, our customers, which a lot of them are discounters, a lot of them are e-tailers, they're really growing. They're opening more and more stores every week. They're taking more market share from some of the other retailers. So not only are our customers growing, they're actually then giving us more space because they've seen how well 88 Vape's gone. And our top 5 customers gone from having something like 10 SKUs to something like 30 SKUs in the range of 88 Vape, and they are growing. And as they grow more and more SKUs, they become a more destination place for 88 Vape, and it becomes even more important for them to have it in a prominent position. So the markets are growing, our customers are growing, we're growing because we're adding more shelf space, and we are all the time adding new customers to our portfolio, which I think we're going to come on to in the next slide. Sorry, the next slide first. I just want to explain how the manufacturing side works. At the moment, there's vaping is very mature in terms of we've now been manufacturing vaping since 2015. We've got a facility now that can double in capacity, and we still would not need to spend any significant amount of capex. We've really got it slick and really working really well. The protein is relatively new. We're still in a process of actually adding more lines and adding more space for this area, because we're just finding that we're growing so fast that we need more space. And that's an area where now me, Suzanne, and the team are actually focusing on how we're growing that space. And then the vitamins will fall into the same space as where the protein is. As I said earlier, we're making tiny tablets, and the beauty with the machine, once you formulated it and once you put the actual powders into the machine, it literally, you leave it for 4 or 5 hours and come back and there's a whole crate of vitamins. The next stage, it goes to a packing process, whether it's a pouch, whether it's a tub, or whether it's a own label for a retailer, whatever spec they want. We will pack it in a format, but it'll predominantly be the same product, but packed in different ways. This area, again, is very new, and we've only just got the machinery, the blends, the know-how, the manpower, and we're testing 1 or 2 of the SKUs of vitamins now, and by the end of the year, we will be producing 1 or 2 or 3 of the SKUs of our 30 product range in the future. So this is something, an area where if we can get this BRC credited, not only will our own brands be sold in supermarkets, well, they'll be sold anyway, but private label, because that is very important for having the quality standards in line to sell own label. And I'm pretty sure that we can be so much cheaper than anybody out there, not even remotely close to us on price, for the same specification, due to our overhead structure that I've mentioned earlier. I'd like to pass you on to Suzanne now, and Suzanne, if you don't mind covering off the financials.
No, thanks, Sandy. Afternoon, everyone. Lovely to have you here. Just as introduction, as it no doubt says at the bottom of the screen, I'm Suzanne Smith. I'm the CFO. Joined the business shortly before we embarked on our IPO journey, and before that had spent time in family businesses, PE-backed businesses, and PLC environment before, spanning distribution and manufacturing. So hopefully have added another dimension to Sandy's strategic thinking. But let me move on to some of the financials for you here. So we've come to the city this week to talk about our FY21 results that we've just published, but I'm conscious that some of you may not have seen the business before today and don't know a lot. So I'd like to just take a step back and really outline the financial metrics more generally for Supreme before diving into the results for this year, if that's okay. So just some headline results, some headline metrics. Supreme has been in growth for the year on year, as you saw on Sandy's graph earlier, about 15% CAGR over the last 5 years. And that's been largely top line revenue growth, has been largely organic, and it has been complemented by some small scale bolt-on M&A over the years, but it's largely organic. And as a result of the drivers that Sandy said earlier, adding in incremental categories, working with customers who they themselves are in growth and operating in markets that are growing as well. We've also been on a gross margin progression story as well. The business started as distribution, it then moved into licensed brands, and then has begun manufacturing, and that has told a really, really linear story in terms of its expansion of gross margin. We're just shy of a 30% blended gross margin today, and we see that continuing to expand as we go forward. Supreme is very cash generative and has been historically, and that's due to the kind of profit growth, modest levels of capex, even in spite of its inroads into manufacturing, a very tightly managed working capital, and also in terms of a balance sheet and the strength of our balance sheet as well. It's relatively low geared, like less than half a turn of EBITDA currently, its net debt. And those financial metrics are also important when you kind of consider the growth story and the general direction of travel for Supreme. As Sandy will come on to talk about, vaping and sports nutrition right now are definitely the most interesting and the most fastest growing areas of our business. And helpfully from a financial perspective, because they're the areas of the business that we manufacture, they're therefore also the highest margin. So even just by function of kind of sales mix, we'll naturally see, as well as top line growth, a better return from an EBITDA margin perspective as well. Also, sticking kind of with the financial metrics and growth, vaping and sports nutrition are largely sourced in the UK or in Europe, and we can manufacture to order. So we're not having to, it's not like our lighting or batteries where we're sourcing from China and we're having a long working capital cycle. We can turn the money fairly quickly. So as we grow more into those categories, our pressures for working capital will start to drop. So the financial metrics are strong, and then we'll get increasingly stronger as the business follows its natural kind of growth trajectory, which makes my job much easier. So let me talk to you just more specifically about FY21 and the results that we published earlier this week, which follow the same theme of everything that I've just talked about there. So north of 30% revenue growth, a mix of organic growth that we'll talk about as we go through the categories, but also the success of some M&A that we did right at the end of FY20 and then partway through FY21. We've seen a slight step back in the gross profit as a percentage of sales this year, on the basis that we acquired a business that allowed us to enter into the branded household consumer goods category this year, which is a distribution category today. So we've taken a slight pause on that gross margin expansion this year, but then we'll continue on that same trajectory I was just talking about. We've seen some investment into the business, into our overhead base as we've become a public company, as we've grown into vitamins and supplements. We've taken on some overheads to kind of acquire the know-how on a kind of temporary basis. But yeah, another very promising and encouraging set of financial metrics. You'll notice that we're not really talking about COVID, which I suspect lots of people's headlines or kind of drivers for their results, good or bad, is COVID kind of related. It's not really the case on a headline level for Supreme. We'll talk later about the operational impact that COVID has had on the business, which, as you can imagine, has been widespread, and keeping our people safe and keeping our manufacturing open and our distribution channels open has been absolutely critical. But from a financial results perspective, the kind of growth trajectory has been uninterrupted. We've had pockets of COVID benefits and COVID challenges across our portfolio of categories, and we'll talk about that when we come to the segments. But actually what that's done is it has reminded us the natural hedge that operating in independent categories does bring a business like Supreme. So for instance, batteries has taken a real surge because of COVID, and the lighting growth trajectory has been dampened by it, but together they're offsetting each other. And as we go into FY22, we expect that battery bounce that we saw last year will kind of level off, and lighting in its place will start to take off. So there's a real benefit there to that cross section of products. The other thing that it's reminded us this year in terms of COVID is just the general resilience of the business and the product categories that we operate in. These are products, batteries, light bulbs, e-liquids. These are products that people buy day in, day out, habitually. They're in your basket every week, regardless of what's going on around us, economic circumstance, global pandemic, you name it. And even when our consumers have struggled to use their existing distribution channels, so the normal shop that they buy may have been closed, or they've not wanted to go out, then they found other ways to buy our products, and we've seen a real surge in our online business as well. So real resilience and real encouraging set of metrics.
Yeah, thanks. So I think one of the, I mean, we're going to come to you later, but one of the questions about the slide before about why is the profit before tax slightly lower, and I think it was the IPO. Do you want to just quickly cover that?
Yeah, well, actually, it's on the next slide. We set out our adjusted items, so I can walk through those at that point if that's okay.
Fine. Okay, so I just want to give you the operational highlights. The good sort of wins that we've had recently is the McColl's retail chain. We've got about 950 stores. We're in all of those stores. They are small stores, so the rate of sale with those stores will be less than some of the other big discounters. The good news is it's convenience, and it's the first time that we really entered into a mainstream convenience chain. The Scottish prisons now, I didn't mention earlier, but we won the UK prison contract just over 18 months ago, and that's been a huge success to the company, not only just for vaping, but we're now selling vitamin D and sports nutrition into the prisons. And the Scottish prisons saw the success of the British prisons, and now they are there listed. And at revenue, I mean, it's about 1.5 million at revenue. McColl's is too early to say, but one thing I can say with McColl's and all the other supermarkets and discounters is that week on week, year on year, it's a slow, gradual increase. Our top 10 vaping customers are all in double-digit EPOS growth. So EPOS means their retail sales out to the consumer. We measure that for our top 10 customers on vaping and on sports nutrition predominantly. And on vaping, they are up double digits, every single one of them in the top 10, which tells me that the vaping market's growing, and also our customers are growing with the 88Vape brand. And that's the same, you'll see the trend with McColl's. It will start off modestly, and then it will grow over time. We mentioned BattleBites, and we've grown the business since we acquired the business by 50%. And we haven't done anything fancy. We've just introduced it to more customers. And that's exactly what we plan to do. We've put a little bit of media behind it and advertising, but nothing too crazy, just to give it that little push. We're talking to some very big retailers on BattleBites now. They see that as a really good brand going forward. The other big wins this year is Sainsbury's. Sainsbury's, we are listed at the end of this month in 406 stores. If it's successful, we'll be rolled out to over 1,000, 1,200 stores. The 400 odd stores that we're in now in the end of this month are the core estate, the main big supermarkets, the main drivers. Sainsbury's have a very good dedicated section of vaping. It's the first time they're introducing a budget entry price vaping brand, which is a great win for us. And how we've overcome that is that the supermarkets were really concerned that a £1 vaping product doesn't fit well with their model because it will potentially devalue their basket. So what we've devised is a 4-pack, so 4 bottles of e-liquid, and they are retailing for £4. So what we've done there is actually the consumer gets the same value, but has to buy more. But what it does for Sainsbury's, it means the basket spend is £4 and not a £1. And that was a big win. And it's been successful, very successful in Asda. And if we see the same successes in Sainsbury's, then that'd be great. I think Asda's our third biggest customer on vaping, third or fourth. And I think the Sainsbury's will be in the top 5 going forward. Maybe not straight away, it will take time. And as we develop it, more and more SKUs, and then you have this cross section. I mean, they are already selling Battle Bites, but they've also now sell the Cymax range that we've just acquired. So all of a sudden we get one EDI order with all these products from so many different categories that we deliver in one go. Core Communication, now for you on the phone, you've probably never heard of the company, but it's a very well managed run company that services 20,000 independent convenience stores with mobile phone SIMs. So how it works, they put the mobile phone SIMs in, and if someone connects one, they get a fee, and the retailer gets a fee. So what they're doing with 88 Vape is they're leveraging their 160 sales team. They're all fully employed sales team, not agents. They're fully employed. They'll go in and they will put a stand of 88 Vape into a store, and they will not charge the retailer. And when the retailer sells out, then what will happen is that they will then charge the retailer, and they will offset it against the mobile phone connections. So there was some cross-selling there going on, and we believe that 2,000 stores is the initial trench, then 10,000, and then 20,000. We've done a 100-store pilot store for the last 6 months, and it's still growing week on week to a level where they are really happy to sign a contract, an exclusive agreement for them in this section, and we believe that they'll do really well. Numbers to be confirmed, but it's early days yet. And then the 2 acquisitions, which I'm going to come on to later, but we look at acquisitions where we can add a difference. Well, Cymex don't manufacture. Well, why don't we manufacture? And well, potentially we could do for the short to medium term. That's not a plan, but in the long term, we will be looking at some point to bring that in house. And same with Vendec, we can add more products into Ireland, and Ireland be a benchmark for the rest of Europe. So I'll come on to the next slide if that's okay.
Thank you. Okay, right. So just a slightly deeper dive onto the income statement, and the balance sheet and the cash flow will follow. That being said, I did say to Sandy at the start, I'm conscious of wanting to give you enough of a flavour of our kind of financial profile, but I know there's a lot more interesting things that Sandy will want to share with you. So I'm going to kind of walk through the key headlines. I'm seeing some questions coming through, and I'm going to try and answer these as we go along. But if there are any more specifics, ask later or reach out to me. I don't want to leave you with unanswered questions, but equally don't want to kind of suck up loads of time. So in front of you here is the income statement, as I'd already mentioned. Kind of 32% revenue growth, some of which was a recent acquisitions, most of which, more than half of which was organic. That came largely from our vaping and our sports nutrition category. They've grown at 36 and 38% year on year, which is a staggering growth profile. As I'd said earlier, the balance of the impact of COVID was fairly negligible, just pockets of ups and downs across the portfolio. And I've already mentioned the change in gross profit margin as a result of the entry of the branded household category. That being said, that margin actually had all we done was add the branded household category, then the 27% we reported this year would have been a bit lower. We've actually made some gains in manufacturing and in vaping specifically, and the margin there has taken a percentage point step up as well, which, when that's our 50% of our business and 50% of our gross profit, then that has a meaningful impact to our blended GP. You'll see there's a set of adjusted items that we've adjusted out this year, the largest part of which was all the costs associated with the IPO, and the vast majority of that is the advisor fees, some small commission sales on the shares that we sold to raise for the company fundraise, but it's 80% advisor fees, as you'd imagine. There's some other elements in here. I won't talk through all of them. The only one I will mention is the fair value on forward contracts, just because it's the most significant, and it's also very, very volatile, which is why we adjust it out every year. It's simply auditors require us to value our Forex forward contracts on our year end every year. So whilst the rates that we have secured for our US dollar purchasing are fixed now for 12 months, which gives us real certainty, there is a cashless book entry that we're required to do at year end to account for that. Aside from that, it is things that I suspect you've seen elsewhere as adjusted items, restructuring costs as a result of us dropping overheads for the acquisitions we've done previously, some share-based payment charges, costs associated with the acquisitions we've done in the year in terms of advisor fees, nothing out of the ordinary. We've seen our overhead base increase 3 million. I think I'd said on the previous page. The step up of that was half to do with direct costs that you would expect to rise in line with sales. So carriage, storage, distribution, commission, and other selling costs. The other half was specific investments. It's definitely kind of a part of Supreme's culture that overhead base is lean, and that there's conscious investment there rather than a general fattening of overheads. That's just how Sandy has run this business since inception. And then if we move over the page onto kind of the segmental breakdown, you'll see here we break down our five key categories and how they have performed. So Sandy will go through this in more detail, but as I mentioned earlier, batteries and also our branded category have taken some bounce as a result of COVID, undoubtedly, as we've all been at home a little bit more and using domestic appliances. We've all been buying more domestic batteries, and our household consumer goods business is focused a lot on cleaning products, Domestos, Cif, Zaflora. So as we were all cleaning our houses like maniacs this time last year, then that category undoubtedly took a benefit. But the biggest drivers of growth you'll see there are vaping and sports nutrition. Vaping as a result of the prison contract that Sandy mentioned earlier. FY21 represents the first full year of that contract, which today contributes about £10 million annually to the category. We've also had a step change in our direct-to-consumer online sales, and I noted there was a question specifically about that. That part of our business, our direct-to-consumer, represented about £2 million of sales in FY20, and this year was 6.2. At the start of the year, we spun up a dedicated hub for the consumer-led distribution, and that continues to go from strength to strength. Even in Q1, as we've come out of lockdown, we've retained the vast majority of those online customers that we gained during lockdown, which gives a promising platform for growth. And sports nutrition, Sandy, I'm sure we'll talk about in a second. It was a division that at the first half, at the start of lockdown, it slowed down a bit. People stopped going to the gym. People weren't buying as many protein powders and pre-workout shakes and post-workout shakes. But what sports nutrition did as a category during the year is it pivoted very, very smartly away from kind of sports-led protein and more towards meal replacements, supplements and vitamins. We acquired a protein snack bar business, and those elements of sports nutrition really supplemented and helped drive the category forward in FY21. And then I've talked already about branded household goods. Margins have been fairly flat across the board, category to category. Sports nutrition, you'll see as a percentage of sales has fallen a little bit, and that's just because of sales mix within the category. Battle Bites is a protein snack bar that is distribution only. We use a bakery to manufacture that. The addition of that category has diluted the overall blended margin within sports nutrition. Moving on to the balance sheet, I certainly won't linger here unless someone has a question, but just to note that you can see year on year a much stronger balance sheet at the end of FY21, and you'll see that we've reduced net debt down to 13 million, down to just 7.5 million, 7.6 million, sorry, net debt at the end of the year. You'll also see there, as we turn over onto cash flow as well, there's a slight change in the profile of working capital year on year, and that's not a result of a significant investment in working capital as a result of a change in the business. It was more that this time last year, working capital was exceptionally low. We had challenges over stock as we were entering lockdown, and we were very cautious with our creditors, and we were holding on to cash as much as possible, just because we were all a little bit uncertain as to how the world was going, whereas the working capital profile you see in FY21 is much more akin to a normal level for a business of our size and our nature. Nothing else, I don't think, in terms of cash flow, so I'm going to hand back to Sandy, but in the meantime, I'm going to just review some of these questions, so if there's something that's worthwhile coming back to, I will do at the end.
Yeah, so this is the battery slide, and if I go back 10 years, or even probably longer, we were doing anything between 30 and 37 million. If I go forward to the 5-10 years, it's going to be in a range between 30 and 35 million. And then with this business is matured. It's with 20% of the market. It's really very difficult for us to expand in this country. Expanding overseas will be difficult unless we had a really strong license, because we've got, with the brands that we've got sort of restrictions where and how we can sort of sell those brands. The margin on this is very, very low, and you know, I think this last year the margin may have been flat in terms of it's not grown that much, but we have had some headwinds of shipping costs, and some of the container prices have gone up, that people are aware. That's also same slightly with the lighting, but again, a lot of the lighting we sell FOB, which I'll come on to later, which is very different. So
Sandy,
yeah.
Sandy, so just to address that specific question about margin and battery, so it's gone from 11 to 10%, I think, year on year, and the reason is that it's just sales mix of brands within the category. So
Right.
just the mix of Duracell and Panasonic versus some of the own brand batteries that we sell, where the margins are slightly lower. So it's just sales mix within the category rather than a fundamental kind of macro driver.
Okay, thank you. Thanks, Suzanne. The next slide is, should move on to, if that's okay. Anyway, so you can see that's, you would have seen in the chart that's for the last 5 or 6 years, it's gone up, you know, relatively significantly over that period. And just on the lighting side, just to touch on that, is that this type of business, this part of the business is very much similar to the likes of UP Global, which is a really extremely well-run business in Manchester. And it's a licensing, and you position the brand just above private label, and then and to move the private label away, and they focus on your brand, which would be Energizer or JCB or Eveready. We see this we see this business continuing to grow, and we see the international expansion on this business being really important for the growth. The international business has been difficult to expand over the last 18 months due to not having any trade shows to go to. There's been very few customer visits abroad. I'd like to move on to the next slide, really. As I say, this element's got 3 different areas. One that was incandescent bulbs and halogen bulbs, and then LED bulbs. We are now 18 months into it now, and it's all LED bulbs. And one of those worry is that LEDs are going to last forever. Well, what's happened is they last longer than halogens, but not as much longer than halogens now. So what's happened is the price has come down of LED bulbs, but so is the life expectancy. So when we first started selling LED, they were lasting for about 50,000 hours. Now they're only lasting 2,000-3,000 hours, which means that they're in kin with the halogen bulb they replaced, and they are slightly more expensive than the halogen bulb, not significantly more. So it's really worked out quite well, actually, the lighting industry. Vaping, 88 Vape, and I think I've sort of covered off the highlights. I mean, if you look at the likes of Mars, PG Tips, we're on sort of par at retail with those guys. It's over 100 million at retail now, the brand 88 Vape, and the brand has grown. And I mean, pretty much you can see the graph does all the talking for us, really. It's a tailwind of the market's growing, and our share of the market growing, and our customer share growing with it. It's really gone really well, and we believe in the next 7-8 years, smoking is going to deteriorate. In terms of 2030, the government's got a target to try and be smoke-free. We have 3.5 million vapers. We've got 6.2 million smokers. We feel that there's going to be a slow slide reversing the other way. This is an area where we've got a factory now that can double our capacity, and we could acquire other businesses, other brands, whilst this business industry is consolidating, and actually reverse it into our factory and cut out a lot of the overheads and motivate the sales team. So I think this is an area where there is potential M&A, but again, to be confirmed. We've got 2 M&As we've done very recently that we're focusing on our energy and integrating them as a priority first. Margins being good on the vaping, as well as the numbers that you can see, the sales revenue as well growing. Going to move on to next slide. It's sports nutrition. Yeah, I mean, this started, as I said, in 2018, and it says 2019, but if we actually started in 2018, and we've grown really well. And I can really happy to say, regardless of our acquisitions, we've had a really good first quarter. It's been strong first quarter on sports nutrition. So we're really happy with the way it's going. And this segment for us is a very, we believe it's probably going to be the fastest growing part of our business in the next 2-3 years. Not only is it a good area to be in, the markets are growing in some of the areas here, but it's also a great category to be involved with, you know, in terms of the amount of grief I got when I started vaping. And I purely believe that I'm getting people off cigarettes and smoking, but a lot of people believe that it's bad for you as well. This is actually really good, because this industry, everyone goes, oh, right, vitamins, yeah, great. You know, so it's a nice one to have to start to go in to improve and demonstrate we can dominate this industry too. And I don't think we can demonstrate, we don't think we can do everything. So we're going to focus on two main areas. One is blended powders. The other one is protein snack bars. And the third one is vitamins. Those are the three areas. There's lots you could do in this area, but let's just focus on the three areas. Out of those three, two we can manufacture, which would be the blended powders and the vitamins. And the snack bar at this stage, it's too complicated, and we've got a really good manufacturer at the moment that we're happy with, that we don't want to change that. So if you take the blended powders, this is anything that you put it into a bag or a pouch or a tub, and we have a licensed brand, so we have brands that we make for private label. We've inherited brands, and this is not just powders for protein. It's also extended to meal replacement products, some like the Slim Fast products, and anything in a powder form, really, creatine, pre-workout, post-workout. And we see that this side of the business is growing pretty fast. You got about everything Supreme do. We come in at the bottom, and everyone fights for the top end. We come, you know, at the lower end, give our customers a really good product, a really good value, and it's sticky. And if there is a recession or is a downgrade or downturn, we find that our products do particularly well. You think we've got so many brands? Well, we have got quite a few brands, but they're different brands for different customers. We've got different competing discount customers that compete, that have got different brands that we keep it separate. Same with the grocery supermarkets, we can do that with them as well. And we found that this whole market is not only growth for us, our customers are growing, but also the markets are growing. I want to come on to vitamins a little bit later, but I just want to say that this is probably the biggest growth area, and is an area of international expansion potentially. I didn't touch on vaping internationally, and the reason is the legislatory outlook across all of Europe is so complicated and difficult in country by country, and it's in changing minefield all the time. And also, a lot of the retailers in Europe are not as being as receptive as the UK retailers in adopting vaping there. That's the mainstream retailers in Europe. So it's been a lot harder to grow in Europe, unfortunately. But we still have one good customer in France and it's doing really well. So the only customer that in Europe we've had are actually been extensions of chains of discounters, like Babou in France is a part of the B&M retail chain. They've done successfully, been really successful with vaping, but that's the only customer we have in France at the moment. Move on to the next, that side, Hannah, that's okay. Yeah, so vitamins. What I liked about vitamins was that the market's huge. It was 450 million when we entered in it, when we started going to it, but this last 6-12 months, it has grown significantly, and that's due to the COVID and everyone taking a lot more vitamins and supplements. We looked at which areas could we do in vitamins. So first, we can manufacture it, great. That's the starting point. Two is, can we create some brands? Well, there's some very expensive, very well renowned brands in this industry. Well, you know, that's fine, but can we introduce a brand that's at private label prices or slightly above, and can we do it in two areas, one for retail and one for digital? And the reason we've gone for one for retail and one for digital is we can be very aggressive on the digital brand, have it in paper pouches so it's plastic free, and get rid of 12 pots, and 12, just so you know, 12 pots a monthly supply of vitamins. It's virtually the cost of the products doubled. It's 50 pence, up to 50 pence saving by taking the box and the pots and the lid. So we were able to cut down on that with the digital offer. Whereas in retail, it's slightly different. They need a box or a pot, and they need to display it. So we've gone down two completely different markets. I cover off and the third market is obviously private label, which we have won a contract for a major discount store, 800 stores, starting in September. So I'll cover off the Sea Lions. Sea Lions is a brand that started on Monday, so it's only this week. We started on TV, a little bit on radio, but mainly TV advertising. I'm glad to say the first few days we're having 7% conversion on our website, which is absolutely brilliant. So the conversion rate's been great, the traffic's been good, the average basket's been £14, which is again great. And because it's flat pack and goes for letterbox, the postage isn't too good. This brand or this product is 365 vitamins for £5. So it's 70% lower than other retailers out there. And we believe that a lot of this market, a lot of the online retailers selling their private label, I think we'll take some of their market share, and I think we'll take market share from maybe some of the Wilkinson, private label bits of it, some of the supermarkets, but not much. I think most of it will come from retailers switching to sea lions due to the value of, £5 for a 365 cod liver oils, for example, which would normally be £50-60 potentially on some brands. Moving on to millions, sorry, on the same slide, on the retail side. This is a brand that we're launching in September. We have a brand ambassador that signed up with Davina McCall. This is launching in, we introduced this brand to try and take away private label. And we've done that with the first vaping customer was Poundland, and same thing has happened here. Poundland have adopted 800 stores in September and removing their private label and replacing it with millions and millions from September. They love the packaging, they love the Davina McCall, they love the advertising we're going to do around it, and more definitely they love the price points, because it gives them a similar sort of price point they were paying for private label, but now they have a brand and they can sell a slight premium. So there are two different areas. So Poundland has started. We have got trials in Iceland. We've also got another two, one discount, one supermarket, very close to dealing. This will be quite mainstream, in my opinion, in the next 12 to 18 months. It's not going to be easy, but we believe that vitamins is a really strong part of our wellness category going forward. Let's go to the next slide. M&A. So I'm just going to talk about the two M&As we've done. Vendek, we bought from a family-run business, a lovely gentleman in Ireland that we bought the business from, and he was coming to his retirement, and we bought this business at 2 and 3 and 4 time multiple. Because it's an island, and we've got lots of customers in Ireland, but we've got lots of small customers in Ireland, and we've got some small customers in Europe. It will be now a place where this will service some of the customers we would have potentially lost due to Brexit, because the paperwork of going back to Ireland has been, and Europe has been quite horrific, especially for the very small customers that just don't want the hassle. So this is we see this as a leapfrog into Europe, and how we see the leapfrog in Europe is not the traditional way. It's very different. It's going to be from an e-commerce way, a business-to-business platform. So Supreme Offers, if anyone wants to have a look at supremeoffers.co.uk, is our business-to-business platform. It's not for trade. It's not for consumers. It is purely for our trade customers that have an account with us or open an account with us. They log on and they can see our whole portfolio of products, and they can buy that product anywhere at the moment in the UK. And it's approaching 10% of our revenue is through our business-to-business platform, anything from £1,000 to £5,000 orders across all our segments. We're going to introduce that same platform in Ireland with Vendek, but we're going to extend that to not just selling in Ireland, extend it into Western Europe as well. Let's see how well it does, but with our products and our pricing, there's no reason why we shouldn't be doing well. The other good thing is they're a distributor. They're exclusive distributor for Osram and Panasonic batteries, and also Duracell, which we will now supply. But the Osram now has led into a discussion talks about UK, and let's see how that pans out. But with these acquisitions, you don't just buy a business; you actually buy a people and good contacts that they have with suppliers and customers. So they've got 3-4 very key customers that we can now start selling some of our other products to. So I think it's a combination when you buy a business, and most businesses we've bought, we've grown it since we've owned them. I would say the 70% of businesses we buy, they actually grow once we're in the Supreme vertical platform. Moving on to Cymex. This is a great brand. I mean, when I started sports nutrition, it's a brand that I really looked up to and I really respect. It's owned by a very big family-run business called Sandworth Brother. Incredibly loyal and lovely people to deal with, and this transition happened quite quickly with the management team being super efficient and our management team working together. And I just can't say how I'm proud of our team, but also their team in making this happen. I was really glad that we did this deal over 2 weeks. It was incredible. This brand has got heritage. It's in Morrison's, Tesco, Sainsbury's, B&M, Amazon. It is really sold across lots of outlets. In terms of the brand, you can see that it has been on a downward trajectory in terms of the sales. Our first plan is to come in to stabilize the brand, and then the next stage is to then look at MPD and then to grow the brand with then a little bit of marketing, MPD, and then extension into our more existing customers that don't sell the Cymex brand. We're not looking at this as digital. I think the Hut Group do that pretty well with MyProtein. I think this is going to be more for retail. Later, let's see if it is transpired to be more digital, but I don't think so at this stage. Again, really happy, really proud. It will be, we believe it will be earnings enhancing, but it's too soon all to understand what that is, because all the customers now are integrating onto ours. How many customers will fall away, how many will not, at this point it's too early to say. The initial first few weeks response has been positive, and it looks that, you know, we're in a strong position to retain most of the business. But yeah, to be confirmed. And that 6 months figure, half year, I'll give you a more of a snapshot on how that's going and how the integration going and what it's doing to our numbers. Next slide will be summary, really. And I mean, I've said everything on here, really, and I just want to go to Q&A, because I think there'll be questions I've not answered, and there's 26 questions here that I've not gone through all of them. So I guess, Hannah, I think I'd like you to, if you can help us select the most important and the ones that most frequently asked, or the ones that you think that we should cover off first.
Good. Well, listen, thank you for an extremely comprehensive review of the business. My apologies for disappearing there, but I'm back now. Right, let's get started. Can sports nutrition and vitamins be as big a revenue contributor as vaping over the next few years?
You see, you've got two people on the call. You've got me as a business that's so optimistic, wants to drive, and I can say it could be 100 million in a few years. But then you've got a realistic here that will tell you a different story. But no. Somewhere in the middle we meet, hopefully, right?
No, you're right. I'm just cautious. I'm not realistic. I'm cautious. So I'll say the same things as you. I just might not say them for another couple of months until we've got some more certainty. That's the only difference.
So the answer is yes. We believe it can.
Great. Okay. With regards to the wellness category, has the business considered expanding into other types of wellness products such as CBD?
So we have tried CBD. We actually own the CBD.co.uk website. We find it quite hard, and there's a lot of legislatory things that are coming around it in the next few years with the novel foods. We decided to park it and not expand in that area. But however, in our Sea Lions, it's not just going to stay at 32 SKUs. We're going to have 100 SKUs in the next 3 months. We're going to have 350 SKUs this time next year. In 2 years, we're going to do a mini Holland and Barrett, but 70% cheaper. That's our game, our aim. That's our aim to do. Whether we get that or not, I don't know. But we're going to certainly go for it. It's a real digital play. The first time we put money, resources behind a digital brand.
Are you seeing issues with shipping costs causing delays in supplies and affecting margins?
Yes. Yeah. I mean, of course, the shipping has been a nightmare for everybody. We are lucky that we're tied into a contract for the next 12 months, and we've only just renewed that. So we're really lucky. I think what you're finding more is delays, and it affected our lighting. So instead of having a container booked in 4 weeks, it gets pushed back for another 2 weeks and then another 2 weeks. So it's more delays. And it's more our customers that we sell FOB. So they actually pick it up from us, and they're finding it hard to pick it up on time. So in terms of actually our margins being affected, luckily we've done a really good deal for the next year. Don't think the actual freight cost will, unless we struggling to get any container, then we have to start air freighting a few bits and pieces. But I don't think it'll move the dial, but that's my view. Suzanne, you agree with that?
No, agreed. I think we're doing everything we can to insulate it. And it comes back to the point we said earlier about it's an added benefit of operating in 5 distinct categories, that something like freight and shipping can wipe out an entire business if freight and shipping affects your whole business. Well, for us, it's very focused on lighting, and we're now really focused on mitigating that as best we can, but it doesn't touch some of the other categories. So there's that kind of natural hedge there again, which is helpful.
Yeah, so on the prison contract, I didn't cover that actually, is that last year we were flying in a lot of the stock because what happens is we make the liquids in the UK, we ship them to China, they put them in a capsule, and then they ship them back. But what happened was the demand was so big, and we needed to air freight. So we ended up air freighting the first 6 months. Second 6 months, that's why the margin was better in vaping. The second month is because we started sea freighting, and we're sea freighting now. Our first stage is manufacturing this in-house. We've got 20% now that we're manufacturing in the UK, so we don't need to ship the liquid to China and bring it back. We've got a lovely company in the Northwest that's going to be making our capsules for us, and we're going to hopefully transfer the actual business from China to the UK in the next 12 months. But yeah, sorry.
Okay. Broker forecasts for revenue only indicate 10% rise this year. Then for the following year, its growth slowing despite being in so-called fast-growing markets. Do you want me to answer that one?
Yes, please.
So we came to market with the IPO in February, and to give it to commit to a growth of 10% year on year, with no sight of how we were coming out of COVID or what M&A may possibly in the pipeline, felt like a balanced commitment. And don't get me wrong, a business of this size to grow it 10% is not something you can do overnight. Even in fast growing markets, we still need to keep ahead of the competition. We still need to manage our own customer base. So there's still a lot of work to do. If we think about this year in particular, I think Sandy touched on it earlier, you'll see that as we put out the results this week, we've not managed kind of the brokers' expectations upwards. But what I would say is that we've not managed their expectations upwards yet, for a couple of reasons. One, it's month 3, and we've a long way to go to the end of the year. And it's a very special year because it's the year the world is hopefully coming out of COVID. And so what kind of consumer buying patterns are sustained that were adopted in COVID, and if we see some wholesale changes, if we go back to lockdown, like, just who knows? There was such a degree of uncertainty. There is such a degree of uncertainty, and combine that with the fact this is still our, we're in our first year as a PLC, and we are very cautious about managing investors' expectations. So, and as well, we've had two acquisitions that we've done. The ink is barely dry on the Cymex acquisition in particular. It's literally 2 weeks ago, and we're still deep into kind of integration. And so what we agreed to do as a board was actually, in terms of this year, wait until our half year, where we will be able to come back with a much more confident and certain expectation. As I sit here now, I would be very confident in operating on the assumption that that will be an upgrade, certainly not a downgrade. But we just need to get a couple of months more trading under our belt. Those headwinds that Sandy talked about earlier in terms of freight and shipping, whether that's inflationary pressure, whether that's just delays. We've also got some significant whey price increasing affecting our sports nutrition category, and they're all things that we just need to navigate through over the next couple of months. So 10% is definitely in our sights, and I wouldn't like to say it's a baseline, because that would suggest that every year we're going to do more than 10%, and as the business gets bigger, that's a bigger leap to make year on year. But we've certainly got some things on our side, as you said, or whoever asked the question here, that we've got some, vaping and sports nutrition markets are in growth, but we're also operating in batteries and lighting and consumer goods as well. So it's about blend.
Yeah, I think one of the questions there, what's the sort of risks are you sort of seeing in the business? What sort of and one is Suzanne touched on the whey prices. They have gone up. Luckily, we're covered for the main business till the end of the year, but we are still buying products at a reasonable price for January now as well. So we think hopefully in the first quarter next year that will stabilize and come back down. 60% of the products, 60% of our profit comes from products we make in the UK. So a lot of the other headwinds, which is the freight and the shipping, hasn't really affected us. Luckily, we're not as exposed to China, so we're quite good that way. I think I've sort of explained the risks around there, and so I explained also the growth where I think it's going to come from in the next couple of years. So the growth is going to come from, I mentioned M&A, more M&A. We're going to do more of that. We're going to get in tune to doing that better and faster. But also we're going to increase the wellness category, and also the vaping market. It's all going to grow. That's where it's coming from. And then venture a new category, but further down.
I was going to say there is a question here on additional categories as well, yeah. Sandy.
So the wellness category in itself has got so much, you can go on forever. So we've got a category there that we're going to just expand more and more in, rather than just going in tangents and keep it controlled. Every time we bring into a new category, we bring in people, we bring in resource, we bring in know-how. It's not easy. So we want to make sure we get it right. So we just want to focus on the ones that we're really confident on. Okay, what else have we got here? CBD, we've done that one. Something about the vaping market maturing consolidation. Yeah, there's going to be further consolidation in the vaping market, and we hopefully be part of that. tax rate, I'm not sure why.
It's right. It's the IPO cost. So all the advisor fees that we see in the adjusted items, virtually £2 million, all of those are disallowable for corporation tax. So that just pushes up your effective rate. Next year, in a normal year, as has been historically, we expect our rate of corporation tax to just track to the prevailing UK rate. It's a really simple tax profile at Supreme. It's just this year with the IPO costs.
So one of the questions is current market cap and where you see it in 5 years. Well, I mean, it's a really difficult one to ask. I mean, my aspiration is to get. I mean, I've not had 100% ownership until February, and I gave up some shares, and I believe that in the long run, the business will grow faster as a public company than it will as a private company. So with access to money, access to so many other things and resources and people as well, you know. The other thing is, in terms of what we are, we're actually a manufacturer and we're a brand owner. That's 60% of our profit. So we're a manufacturer, brand owner, a licensee, and a distributor in that order, really. And I guess if you compare our peers, if you look at our values, then you can see what you think for that. I think there's a question on dividends. I mean, our dividend policy, if everyone doesn't know, at the IPO was 50%, and that was at the time we thought it was a fair dividend. For now, we're honouring that and everything, but in the future, it may change. It could be that if there's big M&A, something that happens that can really grow the business, we can consider that. Or the other way, if we feel that 1 year we've got surplus cash, we'll reverse it and have a special dividend. But let's see, to be confirmed. It's something we discuss at the board all the time. So we don't pay dividend. I'm also the biggest loser as well, and we do. I'm the biggest gainer. So I'm neutral. I just want to do what's right for the business, to grow the business. That's what I'm bothered about. Nothing else.
I think we've talked about. Oh, do you want to do the 88 vape into Europe and US?
I think I've done that. It's not. I'm being honest with you. It's a difficult one for us to grow into Europe. I think I'll grow the vitamins and the wellness into Europe. The vitamins, we have a peel and reveal label on the back of our pouch for sea lions, and on the back will be many languages, and we will then use some sort of platform, whether it be the Ingenuity platform the Hook Group use. Sounds a bit, doesn't seem right, does it, in terms of because they sell vitamins, but they actually encourage other companies to go on their platform for European expansion to tap in. But we may do our own. We're looking at that, but we've first got to make it work in the UK.
One here on the changing profile of gross margin, which is probably more for you, Suzanne.
Yeah, so I think we talked about that as we went through the presentation. So we've had a step change this year with the addition of the consumer household consumer goods category, which is a lower margin, but the kind of more medium to long term expectation is that we'll just see that gross margin continue to expand as we take more and more inroads into manufacturing, which are obviously the highest margin category. So sales mix alone will drive that margin upwards.
One of the questions about competition, actually, because it's actually a good question, because there isn't a single competitor of Supreme. There may be one or two competitors in batteries, one in lighting, in vaping. There's a whole load of companies, but there's very few that specialize in the price point and the levels we're doing. And what we found actually with the competition is that we don't actually. That is one thing we never ever talk about at Supreme, because it never really comes up. And the vaping, what really gives me the confidence, especially on the 88 vape, is when we've had clearance in our sub brand, which was Kick, when we started, and we've cleared it at discount levels through some of the discounters, and it's sat next to 88 vape that's now more expensive. It hasn't sold. 88 vape has sold our own product that's half the price, which is Kick, made in the same factory, selling at 66 pence opposed to £1, and 88 vape still selling 7 to 1. So anytime another brand has come into our retailers, it hasn't sold and it's gone. And that's happened with Poundland, One Below. I can give you so many examples where they hasn't sold because we're already so established in that company. And then in sports nutrition, it's fragmented. There's hundreds of competition all over but most of them are at the top end of the market or focusing at the premium end.
Is that it in terms of the question? I'm conscious that we've definitely gone over the hour mark.
Yeah, it's fine. I mean, I'm okay. Is anything important there, Suzanne? You can see, then we can call it.
Yeah, nothing wholesale. I'm just working capital. 15% of revenue growth is the answer. Do we buy batteries direct from manufacturers? Yes.
Yeah.
Is the battery market in category in long-term decline? No, I'd say it's flat.
Yeah, not the batteries, the market. But one thing, Yeah, no, I guess one thing is just a slap on the culture really of Supreme. We're very transparent, very open with our staff, employees, our suppliers, our customers. We try to be as open as possible where we can. And the same here, if there's any questions, we have the investor email, please just pop it on there, and we'll get back to you. Someone will get back to you pretty quickly on that.
Thank you both again for joining us today. Apologies for the in and out my end. Clearly my broadband feels as hot as I do. So anyway, everyone go off and enjoy this glorious weather, and we look forward to hearing more from both of you in due course.
Thank you.
Thank you.